Black Monday, October 19th, 1987. It's an ordinary Monday. The markets open like any other day. But by the time the closing bell rings, the Dow Jones Industrial Average has plummeted more than 22% in one single day. Hey everyone, welcome back to the channel. I'm Emerald Fox, and today we're diving into a big question. How do you keep your money and wealth safe during a financial reset? It's something more and more people are wondering, especially as the economy feels off. But here's the thing. We don't need a crystal ball to prepare. What we do need is to understand the patterns that show up again and again in financial history. Because, spoiler alert, the same playbook keeps getting used. But the challenge is, most of us just don't know how to recognize the similarities because no one ever taught us how. And when you don't know what to look for, it's easy to get caught off guard. So let's take it back to a wild day in financial history that not many people talk about anymore. Black Monday, October 19th, 1987. Picture this. It's an ordinary Monday. The markets open like any other day. But by the time the closing bell rings, the Dow Jones Industrial Average, a benchmark that tracks 30 of the largest U.S. companies and reflects the overall health of the stock market, has plummeted more than 22% in one single day. That single drop wiped out over $500 billion in market value in just one day. To put that into perspective, if you had even a modest portfolio heavily tied to the Dow, let's say around $100,000, you could have lost $22,000 before dinner. And for higher net worth individuals with a portfolio of around $1 million, that's $220,000 gone with zero warning. It was the biggest one-day percentage drop in U.S. stock market history, even worse than any single day during the Great Depression or the 2008 financial crisis. Financial advisors were blindsided. Some went out for lunch and came back to total chaos. Phones ringing nonstop, clients panicking, and no one knowing what to say. Why? Because while they were trained to sell financial products, they were not taught how to see the warning signs of systemic risk. And instead of fixing the root causes after that crash, the government created a group called the Plunge Protection Team, officially the President's Working Group on Financial Markets. Sounds important, right? But their main job wasn't to protect everyday people. It was to manage public confidence and keep markets from collapsing out in the open. In other words, more smoke and more mirrors. No real change. And ever since then, this cycle has just kept on going. Dot-com bubble, housing crash, pandemic stimulus blowout, crisis after crisis, with more intervention each time, leaving everyday Americans to deal with the fallout. But here's the key. Each of these moments had warning signs. And if you know what to look for, you can spot the patterns early. Let's break down some of the most common signs we see right before a major financial downturn. Way too much debt and easy money sloshing through the system, or too much borrowing and too much money created at low interest rates flooding the system, distorting real value. Stock markets hitting record highs even when the economy is shaky. That phrase, "this time is different," being thrown around everywhere. And the media starting to push that narrative saying prices don't matter anymore. Now, that last one, it's a big red flag. You'll hear things like, "this company is changing the world, so its stock price doesn't need to make sense," or "the market's just different now, don't worry about valuations." That kind of thinking tells us we're deep in a bubble, because when people stop asking, "is this actually worth the price?" they're no longer investing in value. They're chasing hype. And that's often a sign the market is peaking just before prices fall. Let's shift our focus to something real: gold. Back when it was fixed by the US government, gold was just $20 an ounce. Today, spot gold is over $3,000 an ounce and climbing. But here's the wild part. Lynette, Zang, and others estimate gold's fundamental value at around $40,000 an ounce. That estimate is based on the known global debt, now over $300 trillion, and the finite supply of gold, both above ground and still in the earth. There's only so much gold in existence. So if you were to try and back all that debt with a real tangible asset, gold would need to be revalued dramatically higher, somewhere in the $40,000 range globally today. But here's where it gets even more interesting. Each country's specific fundamental value for gold would actually differ. Why? Because it depends on that nation's total debt and how much physical gold they hold in reserves. A country with massive debt and very little gold would require a much higher gold price to restore balance, while a nation with strong reserves and less debt wouldn't need as much revaluation. This isn't just theory. It's a mathematical equation tied to real-world liabilities and limited resources. And if the global system resets, whether through a currency collapse, inflation crisis, or some kind of gold-backed revaluation, it likely won't be slow or gentle. History shows these shifts happen suddenly, often during crisis when confidence disappears. That's why central banks, sovereign funds, and the wealthy are stacking gold quietly in the background, because they know that gold doesn't just go up, it exposes the truth about how over-leveraged and manipulated the system really is. So here's the bottom line. We may not know the exact moment a reset will happen, but when you understand the historical patterns, you can take action ahead of the curve. Because when the system gets shaken, and it will, physical gold and silver have always survived. They're not just shiny metals, they're sound money. And what does that mean? It means gold and silver hold value because of what they are, not because someone printed them or a central bank said so. They're scarce, universally recognized, and free of counterparty risk. You don't need a bank, government, or blockchain to verify their worth. Here's a simple example. If you held a $20 gold coin from 100 years ago, it could still buy a full cart of groceries today, maybe even more. But a $20 bill from 100 years ago, it wouldn't even cover lunch. That's the difference. That's why at Zang Enterprises, we help people move out of a fragile fiat system and into sound money strategies built on real, tangible value. If that's what you're looking for, we can help. Click the link below or scan that QR code on the screen to connect with a strategy specialist at Zang Enterprises. We'll help you build a custom plan that protects your purchasing power and gives you peace of mind. And if this video helped you see things more clearly, like the video, subscribe to the channel, and turn on that bell to share it with someone. Thanks so much for watching. And until next time, stay safe and stay smart.